right, so let's get this show on the road. Like the Swedish fish, he says. All right, what are we doing? Oh, okay, so problem number one, look at the Russell. This is always our big concern, okay? We've got the large caps pop back up, but that's on earnings. A couple of earnings reports influenced the large caps, so they came back up. But the small caps have been just trailing off and trailing off and trailing off. And that's where you got to be concerned. That's the broader market. That's the bulk of the people who are now reporting of the smaller cap companies. So you got to be careful about when you're reacting to this. You got to see if the Russell's coming along, and also the New York Stock Exchange is another one you could be looking at. And that's why we started tracking that in our little bounce box. Let's see, we did that yesterday. Phil's posts, yes, good place to start. Oh, damn it. WP post. I don't really want to post new comments. I don't really want to post comments either, but let's just do that. Yes, remember me. Why do you not remember me? Oh my God, I signed up for a Stripe account today, and the hoops they make you jump through are just crazy. I mean, I certainly feel like it's secure, but I was like, holy cow, guys. Oh, this is taking forever. There we go. Oh, that's what it was searching for comments. All right, now let's get back to my site, please. There you go. Now we have access. That was yesterday's post, which we should be talking about. That's a great picture. I'm happy with that one. What was I looking for? Not Boeing. Something else was. Oh, NYSE. Right. That. Okay, there you go. So, you know, when I started doing bounce lines, they've got nothing to do with charts. It's a mathematical equation. The 5% rule is a mathematical equation, and I just put it in a spreadsheet and calculate the bounce lines, and it kind of works, you know, like it's like a synthesizer, right? You have the green bouncy line, and then it gets into the red lines and whatever. So the idea is, if you're making progress, so you want to start seeing the greens, and you want to be adding greens and not losing them, and seeing those reds disappear. If something's kind of at the limit, that's where you're going to see that. And where is the NYSE at the moment? Well, let's refresh this. That's interesting. Yeah. Oh, damn it! Should have made more note of it before I refreshed it. We boomed out of this. This is from last week. So we boomed out of this and had a very positive breakout. This is what, you know, it's one of those triangle squeezy things, right? It comes into there and it's going to make a decision. It made it a little bit early, but you can see how the 50-day moving average is pushing over the 200, not days, this must be hours. The 50-hour moving average is pushing over the 200-hour moving average. So you're going to get a bullish cross here at the same time that this is going to start rising again. But still, it's not likely. See here, you would have said the same thing here, right? And you had the same move here. See how similar that is? And the RSI was here. So it all looks good for a day or so, or a week. This is a week, actually. So it looks good for a week, but you know, then things can turn right back down again. And you see what happened here? It was going well, and then it turned back down, and then you had another death cross, and then you had a really big dip. So, you know, you don't, just because you bounce over something doesn't mean you're going to sustain it, you want to see what the volume looks like and so on and so forth. And then more, and you see this is a big warning sign, right? You're getting up here and you've got much more red than dark. So more selling in each period than there is buying. There's a spike of buying and a spike of buying, but mostly selling. So, and if you added up the volume, you'd see more volume selling than buying. So, and that's what they do. I mean, they being the people who manipulate the markets, the big they. But that, like, look, as Jim Cramer laid out in great detail, and God bless him for doing it back in the day. But when Jim Cramer was newer to the business, he there's a video of him. You can just put in Cramer market manipulation. Cramer market manipulation, and it should pop right up. Yep, see here? That's 10 minutes. There should be a longer one. Ha ha ha. Is it only 10 minutes? Yeah, apparently so. But here it says he explains the basics of the stock market. Here it says he explains how hedge funds scam the market. That's a more accurate description. He gave a nice explanation. I think this is the one, but he gave a nice explanation of how hedge funds manipulate the market. They'll jack up a stock that they have to sell. So they've got to unload a large amount of Boeing. And so they'll call their buddies in the media and they'll start a rumor that something good is happening in Boeing. And how do they do that? They call people who they have a good relationship with. I have a good relationship with press people. And if they call me up and if I was dishonest, I could easily say, hey, I heard such and such. Doesn't have to be true. I just heard it. But they're gonna, knowing the press people, they're going to run with it. They're going to say, oh, Phil knows what he's talking about. And they're going to run with it. You can't burn too many people too often, but that's why you develop a network of news people you go to. That's why you see these guys pop up on news show after news show after news show. They want to be friends with all these people so that when they feel like it, they can drop rumors. They're not on there being benevolent. They're on there to build their network. And they can pull strings when they want to. And all they have to do is float a rumor or have and they also have other people who do releases to the press and so on and so forth, and they'll release a note to the press. They'll start a rumor. They'll hit the Reddit boards. There's all kinds of ways to manipulate the market and get something going, and just try to jam up the stock a little bit. And that's what you want, because you're going to be selling. You're going to be selling. So you start buying. You start a rumor. People say, oh, somebody's buying, you can see the stock going up and the stock's going up and there's this rumor, so the rumor must be true, blah, blah, blah. And then people start rushing and the retailers start coming in. And then you, the big guy who started the rumor, it's a rumor, you're selling into all the retailers and you're getting a better price than you would have gotten. Had you just sold without starting a positive rumor, then you would have driven the stock price lower while you were selling and possibly damage it. So if you have a large position, you do things like that. Well, you shouldn't, but people do. If you're a hedge fund manager, that's what hedge fund managers very, very often do. It's despicable, but that's how the business works. And Cramer lays the whole thing out and explains how it works. It's a very good video to watch if you haven't seen it before. So what were we talking about? Oh, we were bounce lines. That's right. Oh, this all started when I was trying to look at the NYSE. So there's the S&P. Now let's get a gallery view. Okay, so the NYSE is just over its 50-day moving average. It's well over its 50-week moving average. So it's over its 50. So it's based. Well, obviously the 200-day moving average is the 50-week moving average. See how that works? Roughly. Well, actually more so, because if you think about it, it's 200 working days. So it's more like a 40-week. It's hard math. It's more like a 40-week moving average, but the other one is a 50-week moving average. So So when you're looking at a weekly chart, you have to realize the 200-day, because it's 200 working days, whereas the weekly obviously is not working days, right? It's the weeks. So they're almost the same thing. The 50-week moving average, which is at 16,636, and the 50-day is at 16,576. So they're not too far off. They're going to be roughly the same average. Actually, you know what? That's actually, I never really thought about that. It's actually good to compare these two lines. So which way is it trending? Because the 200-day moving average is shorter term than the 50-week moving average. Therefore, this is an early indicator. This is a strong early indicator of that, and this is trending down. It went from 636 to 576. So there's a downtrend in the 200-day moving average that is not obvious from the 200-day moving average, but it's showing up here because there's this divergence going on. That is cool. I never thought about that. How weird. You see how this is like noisy? Well, no, this is longer term. I'm sorry, this is over years. So this only goes back to last November, and last November is only here on this chart. So different time frames and all, but the point is, this is essentially the same line over a shorter time frame, but it's a little bit shorter. It's 40 weeks versus 50 weeks. And that means that this is going to react faster than this. And that means that this is a great leading indicator for where the weekly is going to be. Oh, I'd never really thought about that. That's really cool. So glad I explained it to you. I never thought about comparing those two directly. So anyway, the point being that we're barely above the 50-day moving average. And we're still well below. This is 18.3. Well, it's not that far below. It's only 400. So this is 18.3, and that's 17.9. So 400. 400 divided by 18. 18342. 2%. We're only 2% below the high. So this, and that's also very important, always get your perspectives, right? This is only 2%. So these lines aren't that far apart. This is about 5% down. So we're 5% over the 200-day moving average. We're at the 50-day moving average, which is 2% below the all-time high. So most likely this is our correct range, 2% up, 2% down, 2% up, 2% down. That's likely going to be our range, but we know now that the 200-day is dipping. And again, we're now coming into the broader earnings, and that's why you got to be concerned about that. So meanwhile, this entire conversation was about the fact that this is 17,963. And if we go to there, we see 17,963 means we've turned that green since yesterday. So we've actually gained a green box, and we're in pretty good shape. So unless we blow that, none of this is at the, see, when you once you get past the strong bounce line, there's no reason to be worried about anything unless you start losing now strong bounce lines. As long as the strong bounce lines are green, it means the strong bounce line is holding, and that means that you should be in the upper end of your range. And this would be the range that goes back, takes us, these are each about 1%. This is the range that takes us back to the all-time, to the highs. Not the all-time highs, because the Russell was even higher than that. But generally, we made good progress for the last week. Everything's been on track, and things are going generally well. So that about sums that up. Nothing to be alarmed about so far. But what we do have to worry about is this briefing? Your briefing, very good. Earnings calendar, refresh. This is what I'm worried about. This is what anybody should be worried about, okay? Red, 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 red. That's concerning. That's really concerning. That's a bad morning. That was Monday morning, right? Yeah, that was Monday. Monday night, red, 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 red. That's not bad. Red, red, red. Oops, red, 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 red. Not terrible, but red, 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 red. Okay, Monday night was better than Monday morning. Red, 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 red. No, this is fine. Red, red, red. Obviously fine. This is like when popcorn is. it's like when your popcorn is just about finishing the microwave and it just like pops every once in a while. That's good. See, if you have finishing popcorn sounds when you're going through the list, then that's good. If you have this, so if you have red, 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 that's beginning popcorn sounds. That's not good. You don't want that. You want the finishing popcorn sounds. All right. So then this is last night, I guess. Red, 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 red. Oh, red, red, red. That's not very good. Red, 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 red. Ooh, oh, wow. Holy crap. What is wrong with the M's? The whole section there. Holy cow. Ew. Oh, way too much red. Way too much red. Too many misses. This morning, of course, if you're going to do a better job, you pay attention to the actual size of the companies that are missing, the size of the companies that are beating. It's an overwhelming amount of earnings. When that's a problem with earnings season. There's so many freaking reports that even the summaries are just too much information. And in fact, frankly, the AIs can't handle it either. It's too much data for them. Oh, and this is tonight. So Monday morning was a complete disaster for earnings. This morning's not terrible, but you have to think about who beat and who missed. So who do we care about? Budweiser's big, they hit. Avido, who cares? Oh, BTG. I was thinking of picking them. I came very close to picking them for the $700 portfolio. Oh, we should take a look at that. But I decided not to because I couldn't decide if earnings were going to be good or bad, and they came out exactly on track. So Broadridge, who cares? Choice Hotels, all the travel people are doing well. Dine Brands. Ooh, see? Consumers. Doesn't like that. Don't like it when consumers are doing bad. EchoStar, who cares? Emerson, beat, but bad guidance, so that doesn't count. Boy, how can silver companies not be making money? Silver is so much more than last year. Genius Sport, don't care. Hanes Celestial had a beat. Immunicore, no, not a big deal. Middleby, I like them. Oh, they had a miss. See, that's consumer. That's Middleby is grills like Viking and Weber and things like that. So consumers pinched again. Mastercraft guiding down. That's more consumer stuff. They had a beat, but they guide down. New York Times with a huge beat. Very good. Thank God. We lose them, it's all over. It's like one of the last real papers. I know you conservatives don't agree with that, but if I want to know what the actual facts are, that's where I go. Shopify had a beat, but everybody sold it. It's off 20% on that beat. And that's the other thing. I mean, you see a beat, that doesn't mean the stock's doing well because the expectations are too high. People think everything is 23% increase in revenue and they drop 20%. Why? Because they're up 100%. It's stupid. Starwood, another hotel chain, Suncor Energy. Wow, very good Suncor. Sunoco, kick-ass. These energy companies are doing well. Taboola. Tenga, Tiva, Miss, TripAdvisor, anything to do with travel, man. We just added it. We added Trivago, actually. Uber, horrifying miss, horrifying. That's a tough business, man. And Uber, oh, and by the way, I don't know about you guys, I almost never use Uber anymore. I always use Lyft. Every time I'm going to take an Uber, I look at it and I have sticker shock. I still use Uber Eats. Probably shouldn't, but yeah, I don't pay, I don't worry about that as much. Actually, it's kind of weird. They're probably ripping me off more for Uber Eats than they are for the like going to the airport, because going to the airport, I put in the airport, and Fort Lauderdale is like $75. I'm like, $75? What are you insane? I go to Lyft, it's like $45. So that for some reason gets me pissed off, and I refuse to do it. But food wise, I'm sure they're gouging me for like $5 or $10, like 5-6 times a month. So they're probably getting me on the food anyway. But Uber, yeah, I mean, Uber's gouging. In fact, all these food services, I think DoorDash just had a big sell-off. All these food services, again, people are not in happy times now. So between the price of the food and the insane fees that they tack on to the food, I mean, you're paying like at least 30%. I think sometimes you'd be paying up to 50% more than if you went and got the goddamn thing yourself. So that's a little insane. And not only that though, but I object to their whole business model, which is that they're taking 30% from the restaurant. So they're stealing money from the restaurant. The restaurant struggles. So even though you're patronizing the restaurant, they're not doing well because you're basically using a 30% off coupon every time. But the restaurant doesn't benefit, and you don't benefit. Uber benefits. They're taking all the money. Oh, what is that thing? My friend just started a new app. I'm gonna have a meeting with him, in fact, about that. What does he call it though? I can't remember. When I remember, I'll talk about it next week or something. But he just started a community-based food delivery app that's only hitting the restaurants for 10% and pays the drivers minimum wage, guaranteed minimum wage for the drivers. So I like that. I like his business plan. He's like, because he's like, basically, we don't need to make that much money. Uber makes insane amounts of money. Why do we need to make $1 billion? We're happy with 100 million. And that's a problem when your business model is to completely rip off your customers. I mean, look at Uber. This is your money. I mean, actually, this is your money. This is all the revenue Uber gets is over and above the real cost of your food. So they're ripping you off, and they're ripping the restaurants off to the tune of 40-something billion dollars, $50 billion. Well, I mean, I'm sorry, there's a lot of taxi revenue there too. It's not all food, but that's kind of insane, and they're making billions of dollars. Who's awake? Oh no, I need a co-pilot. What percentage of revenues is Uber Eats for Uber? Revenues and profits. Uber Eats, $12 billion freaking dollars. What is orders placed? Oh, okay. There you go. That tells you right there. The total value of orders placed on the platform is 67 billion. So they basically charge 20% in the gross bookings of orders or something like that. Or wait, gross bookings, total value. No, they charge the people too. So it's more. Yes, it is 30%. Internationally, Uber Eats is the most popular, 88 million users across 11,000 cities. Wow. They take 20 to 30% from all orders, resulting in a high margin. Uber Eats is profitable. Over the years, Uber Eats has reported lower losses, indicating progress towards profitability. The company also explored cost comparison with ride hailing. Uber Eats contributed 45% of Uber's revenue, surpassing the revenue generated from the ride hailing application. However, the gap between the segments fluctuated with mobility, blah, 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 blah. Okay. So yeah, it's significant, and it's it's based on ripping people off. And when the economy starts slowing down a little bit and people start looking to economize, and I'm hearing it from people all over the place, it's one of those things that you have to say, I can't do this. I can't spend 35 bucks for a pizza. Right? That literally happens. In fact, there's this place Sazio across the street from me, and literally across the street. Like I have to be so lazy that I won't make the trip that I want to think about 100 feet. It's not 300 feet. It's not 300 feet from me. But it's a pizza. When you're ordering pizza, you want somebody to bring it to you. But no, because for one thing, their pizzas are ridiculously expensive, like 25 bucks for a simple, couple of topping pizza. So it's 25 bucks for the pizza, and by the time it's delivered and you got to give the guy a tip, it's like 40 bucks. And Sazio's giving up 30% of the pizza cost. So I mean, that's insane. So the only people making money on this thing, well, the driver's happy because he's getting a tip. He's getting like a $3-4 tip for like bringing the pizza across the street. But the whole thing is ridiculous. I mean, it's $15 just going to the wind for no reason. But that's how Uber Eats makes their money. And where were we? There. Okay, Uber. Right. So what the frick? How do they lose money with that business model? That's just so insane. So I imagine they're spending a lot of money on AI development and so on and so forth, but they've definitely got a lot of work to do. I don't know what United Parks and Resorts does, but they did well. Valvoline, Vertex, very good, very surprising. I didn't think they were going to beat by that much. Anyway, so we're seeing trends. We're getting an idea of what's going on, but it all comes back to the same trend, which is a squeezed consumer. And especially, it's a weird thing because consumers, it's not that weird. I mean, COVID ended, and people literally haven't seen. You guys are people. Let's talk about this, right? When's the last time you've seen your distant friends, your distant relatives, right? Even if you started traveling a little bit, it's like, I mean, I could tell you, like, I got like 6 different cousins I haven't seen in 5 years. It's just not normal. We just had a wedding, and I saw a bunch of my cousins from overseas for the first time in more than 5 years. And we were just sitting there saying, this is terrible. It's like, you never thought, we're a globe-trotting kind of family. And we never thought when we settled, I have cousins in England, I have cousins in Canada, I have cousins in South America, I have cousins in California, of course, I have cousins in Texas. So, we have people all over the place. I have people from France. So, when you settle all over the world, I have cousins in Israel. There's no chance I'm going to see them at any point in time. So, we didn't expect when we settled down that we'd never see each other again. England, my grandparents, when they were still alive, this is when I was young, before 2000, basically. So I was more like 30, 40 in that range. But when I was that age, I would go see them at least 3 or 4 times a year. They're only in England. I was in New York, so no big deal. I got on a plane. I'd leave work on a Thursday usually. Especially if it was a holiday weekend, any holiday weekend, I'd stretch it like an extra day. So I'd leave work on like Thursday and I'd come back on Monday night. But it's the way the time zones work. Because if you leave Thursday night, you get there Friday morning, and then I'd see my grandparents Friday, Saturday, Sunday, and then Monday afternoon I'd leave, and you basically get back, not too long after you leave, coming back, you are a total train wreck the next day. That you cannot plan on being productive the next day, but it's my company, so it's okay. And I'd do that whenever we had a long weekend to get away. I'd go, well, not whenever, but on a couple of long weekends, I'd go see my grandparents in England, plus my other relatives that were out that way. So, it never seemed like a big deal. COVID cut us all off. It just basically cut all those strings, and nobody could go anywhere, and nobody traveled, and nobody was visiting. So there's a lot of that to many extents. So people are now saying, oh, well, let's go somewhere for a wedding. Let's do this. Let's go that. Let's have a trip. So the travel stocks are having a backlog, but it doesn't mean they're doing well. It just means people are really pent up and are willing to spend their money on stuff like that at the moment. But when they come home, they got bills to pay. And so the next vacation is probably not going to be the blowout that these vacations were. So I think the travel companies are going to have tough comps going forward. I like Trivago. It's a small little company and they're growing, so it's different. But the bigger companies that have taken a lion's share of the money, like Booking and things like that, I think they're going to start feeling a bit of a squeeze back, especially if we keep having all these tensions between US, China, and stuff like that. So that's going to cut down on a lot of those big trips as well. And these visa issues that are popping up, and people are cutting back. It's not as easy to go back and forth to places as it used to be. And what was something about Canada barcoding people or something? I don't know what they're doing. Not barcoding the people, but you have to have like a QR code to get in and out of Canada. Yes or no? You have to have permission if you're going to travel across the border. You have to do it in advance and register and get a a QR code that allows you to go through the border. You can't just go, and that's kind of crazy. There's lots of weird stuff happening. Oh, Rivian. Oh, that's not good. A big miss by Rivian. I'm very off of this company now. I was kind of liking them, but as a viable Tesla challenger, but the cost of repairing one of these cars, if anything happens in an accident, they're like almost uninsurable. They're very, very big point. Goes for a lot of cars these days. Before you buy a car, find out what it costs to insure it. Before you buy a car, say, oh, I think I might buy this car. Call your insurance company and ask them what it's going to cost to insure it, because you cannot take for granted with these hybrids and electric motors and all the crap and the computers these days, you don't know which cars are an arm and a leg to repair. And it's getting really nasty. Some of these insurance rates are just crazy. And I feel terrible for the people who get stuck with a car and they can't even, they can't change their circumstances. They got a car for 3 years and their insurance goes up $100, things like that. I mean, a month, not $100. So Rivian was one of the cars that I was reading this article about, and I was like, holy shit. I mean, just, insane amounts of money if you have to fix anything on it. So we'll see. Anyway, so getting back to picking stocks and so on and so forth, let's talk about the $700 a month portfolio. So this portfolio, we started with $700 in August of last year. Pretty sure it was August of last year. 20 months? Yeah, it sounds right. Okay. So in August of last year, we started with $700, and we obviously had very limited choices. In fact, here you go. That's right. Why wonder when we can pull it right up? August 25th, 2022. Oh, 2022, 2 years ago. Sorry. That makes more sense. So here was the strategy. I laid it out. I said, look, here's what we're going to do. We're going to put $700 a month. We're going to start with 700. We're going to add 700 a month for 12 months. And we're going to give it 30 years. And we're going to try to make 8%. And what's that going to do? That's going to give us $1 million. How much money are we actually putting in? We're only putting in 360, right? 360 months times $700. We're putting in $252,000. So over the course of 30 years, we would put in $252,000 and we would make $750,000. We make 300% a return on the money. But, well, it's crazy now because we're obviously making 30% a year. But here I calculated if we make 18%, it will only take, I'm sorry, if we make 18% for 30 years, we'll end up with $9 million. Same money, just if you can make 18% instead. We're making right now 30%. So what was the first stock we picked? Was AT&T. I could only buy one stock with $700. My pick at the time was AT&T, and it was 18 bucks at the time. And we sold some calls and we sold some puts, and that was it. And we collected our dividend and we waited for the next month so that we could have some more stocks. Oh, this was the dividend portfolio. Okay, that was like, that's a lot of stocks. So that's what we did, and month by month by month, we added $700 more. We used the money, of course, that we made. AT&T matured, we cashed it out, we collected dividends, we put that towards more stocks, and we're just rolling the money along as it comes in. And so far, so far, we're up 60% in less than 2 years. So we're averaging 30% a year. And that's going to be insane. If you look at the compound rate calculator, Money Chimp, that's my favorite, bank rate, Money Chimp. So, well, all right, so $700 a month, 8,400 in 20 years at 30%. That means you're putting in a lot less money. You're only going to put in 700 times 240 months. You're only going to put in $168,000, but it's 30% returns. Not that I expect to keep it up because we're going to eventually have a bad year. $7 million in 20 years. You know, so the real thing, and this is so important. Bring the kids, get the kids in here. Let's have a chat. So really send this to them or whatever. But the real thing here is that you've got to understand the value of doing this. That what are you doing with $700 a month that's more important than having $7 million in 20 years? You got to be able to find the money. You've got to figure out a way to put the money aside. And I'm sorry, if you can't possibly do 700, then do 70, and you'll have $700,000. Not as sexy as 7 million, but 70 freaking dollars a month. And I know the people who I'm talking to now have them, have more than that. But the point is, anybody, if it's your kids out of college, they've got to get this discipline, and it's got to be important to them. And if they understand this math, it would be important to them. Because especially if you have more time, if you have 40 years and you only make 18%, it's $41 million. Even with inflation, that's going to be a pretty good amount of money. But how much money would that be? Let's see, with inflation. 40 years ago, I don't even know what year this is. This is 2020, so it's 1980 something. In 1980 something, I had a Mazda RX-7. It cost, I'm pretty sure it was $30,000, and it was a good solid car. So now it's $75,000. So let's say it's 90. Not an RX-7, but I had an RX-7 convertible. Let's say it was $90,000. Now that's only 3 times more. So even if you divide that by 3, you'd have 13 million real dollars, even accounting for inflation. Of course, not college, because college I spent, I spent probably about 32,000 something in college. And now it's more like 250 is 8 times. So even 8, but again, even if you divide it by 8, you still got $5 million of today's money, right? So in other words, it's still good money. So even with a decent clip of inflation offsetting your gains at 18% average returns, which is way less than what we're doing, this is still worth doing. Your kid now, 20 years old, starts putting away $700 a month for retirement, boom. And that's another thing. Rather than you giving your kid this and giving your kid that, you got to do this. This is a more important thing to do with your kids. Give them this money and put it in an account and teach them how to manage it and teach them how to invest it and roll it over. Because then they'll be set for life. And not only will they be set, but then their kids will be set, and you'll be doing something for generations of your family down the road. This is a much better thing to do with money than buying somebody a car or buying them a house or whatever. It's like, this is permanent. This is gonna get them into a comfortable retirement. It's gonna set their children on a path to success. You know, what's more important than that? And anyway, so that was that. So anyway, that was the purpose of this portfolio, and we've been doing it for 20 months, and you can see month by month by month all the stuff that we did. And so at this point, we're up 60%, and we have, what was that number? $23,500. So, you know, in 21 months, we've put in, well, I did the math somewhere. We have a starting basis of 14.7. So we put in 14.7, we have 23.5. It seems so boring because we're just really, really early on the compounding cycle. You know, it's the compound interest is very, it's very boring when it starts, but as it goes on, it gets very, very exciting, especially near the end where you're just making incredible amounts of money, because obviously $40 million, right? 20 years from now, $40 million or whatever. You then make 18% on that, you're making $6 million in 1 year. And you started with freaking $8,400 in a year. So, you know, I always say to people, I'm like, you know, this money you say you can't possibly have, you can definitely have it down the road. And you just gotta learn to scale back a little bit while you're young and put it aside. I know it's like super obvious advice, and obviously, you know, you guys, we're all investors because we took that advice at some point in our lives and didn't spend everything we had, but you know, it's a life, it's choosing a path in life that's going to be much better for people. And I can't convey enough how important this stuff is. And the positions we have at the moment had $17,000 of upside potential. And that's 73%. So for the next 2 years, we don't even have to make any moves and we're set. If this thing just moves, if this plays out properly over the next 2 years, we're still on track for 2 more years at 30%. And so, you know, these are the positions. There's only 12 positions. And I'm not going to talk about every single one, but here's Ford with 121% left to gain. Here's Levi, that Levi blasted way, you know, our Levi goal was 20 and we're 10% over our goal already. It's doing very well. In fact, Levi was net 18, 19, something like that last time. So it's now net 29. So we've you know, a good portion of the gains for the portfolio this month were Levi from this blasting up, because we were at a down part, and it's only 10%, but that's how quickly we make money using these spreads that we design. Pfizer, and again, we just doubled down on Pfizer when they were down in April at the last review, and they're popping back up, so we're very happy about that. And this has 200, see the spread as it is now, let's look at that spread. Pfizer. What is that spread on Pfizer? It's a bull call spread with no margin. The 30-35 spread. Pfizer's at 28. We wanted to get to 35. That's $7 up. That's pretty much 25% or 20-something percent, but over 2 years. So we think it's going to go up 10% this year and 10% next year. It's all it has to do. And we're going to make 200 and something percent if that works out. Look at the spread. It's only net, $1,400. And it's a $5,000 spread. That's pretty simple, right? There's no margin. We're taking a blue chip stock and we're betting it's going to grow 10% a year, and we get a 260% return for that. This is why options are phenomenal. We're using no margin. Let's keep that in mind. No margin required. Simple bull call spread. Not an ambitious target. We're looking for 30. Wait, why does it say 20? Are we looking for 30 or 35? No, we're looking for 35. We're looking for 35, which is up here, in 2 years. So we're looking for it to kind of get back to here, but it was much higher than that in previous. Here's SoFi, and I said I'm tempted to double down. This is a 227 upside potential. And our target is 12. So we're looking for this on SoFi in 2 years. SunPower, SunPower has been so terrible. But still, I can't walk away. Every time I look at SunPower, I'm always like, I'm sorry, but Joe Biden's putting in like, $20 billion worth of stimulus in the solar sector. If just a tiny bit drips on these guys, they're going to be blasting up. And they know what they're doing. Their management's, they built a great company and they screwed it up so badly. It's really awful. So now they decided, and they're redoing the whole company. So they decided that they're not, the installation business sucks. It's like having a construction company. So the installation business sucks. They're getting out of that, subcontracting the installations, and they're just going to sell systems and work with the installers. And it's a good plan. It takes away this overhead, because what happened to them in California, they had all these installers on payroll. Then the rules changed in California so badly, the rules changed against the solar industry so badly that all the homeowners canceled their things. They're like, I can't afford this. It changed. Everything changed. The tax rebates changed. Everything's changed structurally. So, so they're paying all these guys to sit around twiddling their thumbs, and the company lost a fortune. That's not going to be repeated. They said, let's not do that again. But it's still going to be a while before they can get back on track, because a lot of the revenues was coming from installations too. Here's good old AT&T. Remember, it was the first thing we bought, and it was 18, and now it's 17. And you know what? We still play it the same way. Well, actually, we're probably not selling puts now, because I didn't want to sell any more puts. We have bull call spread 15-20. Now, if this were one of our more aggressive portfolios, we would have sold puts, and we would have also been selling calls along the way. But in this case, a simple 15-18 spread, it's $3 in the money. So it's $3,000 in the money, and the net of the spread is $2,000. So I'm buying a $3,000 in the money spread on AT&T that will pay me back $5,000 if they're at 20, $2 higher, in 2 years. That was our first trade, and we still have it. Not the same one. We've cashed out the original one, of course. So 150% upside potential on a simple little thing like that. So you say, wow, how does your portfolio make 30% a year? Because we have trades like this. They don't all have to work out to average 60% over 2 years when your goal is 150%. This thing can practically fail and make. In fact, it is. It's 50% up now if it just stays at 17. It's a $2,000 spread. That's $3,000 in the money. Therefore, it's up 50%. So when I start up 50%, it's like being bored on third base, right? I start up 50%. I only have to do a little bit better than that to be right on track for our 30% average gains. Trox in November, in Thanksgiving actually, in November, this was our trade of the year runner-up, and it's doing it's doing a lot better than Valley too. But Trox was our runner-up for trade of the year, and it blasted higher, did exactly what we thought it would do. Very good trade. Still has 47% remaining upside potential. And again, these are bull call spreads with no margin, no selling puts, no tricks, no nothing. Just straight up pick a good stock and say, I think this will go higher, and you can make this kind of money. Here's Valiant, has 187% upside potential at 15, and it's halfway there. So this one again, it's net 2090 and it's $3,000 in the money. So this is in the same basic position with 187% upside total potential. You know, these are not risky trades. This one seems risky because it's so bad. Walgreens cannot get out of their own way. It's a shame. Earnings are on the 28th, so we're going to see what happens then. But you know, here you go, 112% upside on this one, and we need them to get to. I don't know what I need to get to. What's the number? Walgreens. 20. We need to get to 20. And surprisingly, whoop, wait. There you go. Surprisingly, it's at 1750. So 20 is not crazy. So these are not. Well, this is what I mean by conservative play. We're picking value stocks that are down, that we expect to come back over the next 2 years. And if they do, we make 100% here, 200% there, whatever. That's it. Simple bull call spread, no margins required. You can teach your kids how to do this. Here's our hedge, is the SQQs. And this has $18,000 of upside potential. So we're covering our $23,000 portfolio with an $18,000 hedge. So it's a pretty bulletproof portfolio with this coverage, and that coverage is going to last us 2 years. And that coverage cost us it's $2,000. So for $2,000 in a portfolio that's going to make $17,000 if all goes well over the next couple of years, we have taken 2,000 of that 17,000 we expect to make. And don't forget, we'll obviously add more trades and make more. But of those trades, we've taken $2,000 to ensure that we don't lose money. That it's very difficult for this portfolio to lose money on a market dip. And even better, if there is a market dip, the positions might lose money, but they're all stocks we like for the long term. So we take the cash that we make on SQQQ and we apply it to our beaten down positions, and then we'll have bigger beaten down positions, hopefully when things recover. Depends why they go down. Oh, and that's what happens when you fail a triangle squeeze thing. See, it was squeezing, and then oops, it went to the downside. There's always good points of contention. Something's going to happen. That's the thing about those. So in other words, what happened is since the last portfolio review, we had 17,000 upside potential at the last portfolio review. We made some changes. Oh no, I'm sorry. I don't think we did make any changes, did we? No, we didn't make any changes. But we have $18,000 worth of upside potential at the moment. And that varies because I might have changed my mind about how much I think the upside potential is. Like, you know, when I say there's upside potential, I look at the realistic target, not necessarily the maximum. So if I change my mind on something, I don't remember what it was, that can cause a small variation in the upside potential, even if the positions don't change. So in other words, like I may feel better about Pfizer. Oh, we doubled down on Pfizer though. I may feel better about Pfizer than I did before, or maybe I didn't. Maybe we didn't count the new edition last time. Whatever. So anyway, so here's Truvago, and you know we've been considering this for our trade of the year. So when I see it's like all the way down here, I'm like, okay, that seems low enough. And not just the chart, of course. We look at the PE and all that. But I think that's a good line to hold. I don't see that there's a good reason for it to go down. If you look at the last earnings, it didn't kill them. This earnings hurt them a bit. They disappointed, but still, I think the values here at this, you know, down this blue line, basically, I don't think you're gonna get much below that. So in this one, it's a short term also, and I love these kind of trades anyway. All I needed to do is hold 250. The volatility on earnings caused it to have some pretty good options. And I know it doesn't seem like much, but it's a lot when you think about it proportionally. So we bought 500 shares. We sold the 250 calls for 60 cents, but that's 60 out of $2.48. That's 25%. And then we sold the puts for 50 cents. That's also still about 20 something percent. And that's a lot. That's getting 40% back basically. I think I probably did the math somewhere. Actually, it works out to be an 81% return because we're only laying out 690, 1240 minus 5, whatever, is 690, and we'll get 1250 back, which is a $560 profit. All right, but we also have a margin requirement here of basically 1250. So that reduces our spending, our buying power. But you know what? All I have to do to recapture that buying power is buy these puts back. So anytime I want another 1,000 in buying power, I spend 250 to buy back these puts, and I've got $1,000 freed up to buy something else. So if I change my mind, it's no big deal to tie up the buying power, and it's only until October. It's only 6 months. Now in Cheesecake Factory, though, having tied up 1250. I didn't want to sell any more puts. So in Cheesecake Factory, we're going for a straight up spread. And again, notice because of the short time frame, I prefer to be in the money already. Why wait? I don't want to bet it's going higher. I'm just betting it's not going to go lower. I'm betting this line is going to hold and there's value to the Cheesecake Factory. Now, why Cheesecake Factory? Because the consumer is stretched. And we know we have problems there. I'm not expecting them to rocket back up, but I do think they've got a handle on the situation, and I think that they're in good shape. I didn't say anything about it though. It's a little risky, I said. Where is that thing? Here. So cake. So market cap $1.7 billion, dropping a little more than 10 times earnings, basically. They're trading at. Look at this growth, though. This is what I love about them. This is COVID. Bounced right back, right? 3.3, 3.4, 3.6, 3.8. Okay, and whatever happened here, it's not a big deal. They lost money during COVID, of course. Getting back on track. 101, 147, 162. And they're not disappointers over the long term. They know what they're doing. They know what they're going to make. They don't get surprised. This is now we're past the problems of taking things into account. So for me, at 10, I got it. They're undervalued. At 10 times earnings, they should be 12, 13, 15, somewhere in that range. No more than 15, but they're reasonable. Also, not a terrible amount of debt. They've got $400 million in debt, but that's how they grow their operation. It's not unusual for them. So like 232, 126, 276, 353, 414. But look at they're driving their growth and they're doing it properly. They got this thing pretty much under control. I like this operation a lot. I don't see any good reason they're going to go below 35. They'll stay below 35. I don't think they're going to go much higher. And if they go lower, you always have to think about this before you start. If they go lower, I am willing to put some money into it. So in other words, if they drop, to 30, which would be crazy, but it happened. So if they drop back to 30, then we're going to take these October 30 calls, and they'll still have some value. We'll take the October 30 calls and we'll spend money to roll them to the March 30 calls or maybe the 25 calls. So there's such a high return, I don't mind it. And of course, if we do that, we would then sell more short calls. So we'd invest another, hopefully not 1,400, but let's say we invest another 1,400, we still have a $2,500 spread. So even if it drops $5, highly unlikely, I don't mind spending the money and expect 30 to hold. So if it goes down to 30, like it did here, I would expect that if we roll down, spending $1,400 more on a new spread at a lower strike, that we are likely to collect our money back. So to me, I'm looking at the risk and saying we're not really risking $1,400. We're probably risking like $300 or $400 because it's got a good chance that we can recoup this if things go badly. But if things don't go badly, boom, we make 78% in 6 months. And again, it's also assuming, if we break below this rising channel, we're going to know there's a problem. But I don't see one. I mean, the biggest problem, Cheesecake Factory is not like McDonald's. It doesn't matter if they have a few things in California. In fact, because what's the big deal for restaurants is people have a lot of restaurants in California are paying a lot more wages, and it's spreading around the country slowly but surely. How many cheesecake factories in California? Whoa, 52. So that's about 10% of their whole thing. How many in the entire US? Whoa. Highest number is 38, which accounts for 17%. Wait a minute, though, you just said more. 52. That's an interesting discrepancy. It's funny how they reference like menuism. Like, who the hell knows if they know anything? Oh, for God's sakes. 50 seems like a lot. That was more than I thought. And there's only 215 locations? I thought they had more than that. 200 cities. Well, this seems to know what they're talking about. Scrapehero.com. Who knows? Well, they sell data. I think I trust them more than menuism. California with 38 locations. 18%. Interesting. Why would they see? The article said it was 18%, and this thing, Copilot, comes back and tells me that it's 17%. So 38 divided by 215, 17.6. He rounded down. Interesting. That's an interesting little quirk. Anyway, so that's weird. And what is the 334? See, I thought it was more than that. Oh. Ah, it's 334 including other restaurants. So the actual, I knew they had more locations, but yeah, so in other words, the California Cheesecake Factory, if you're being specific, is only 216. Very interesting. Okay. Ooh, price target 36. See, perfect. Anyway, so that's where that pick came from. I had good reasons. So California is only a percentage of their people. Plus, when you have to pay the waiters $20, they I don't know what I don't know how they work it out. They adjust the tips or do whatever. But so for a place like if Cheesecake Factory even falls under that ruling, I don't know that for sure, but I'm just saying California's been, the fast food establishments in California, and it's actually good for them if all their competition has to raise prices. So in other words, McDonald's can't pay slave wages to their people. It's good for a place like the Cheesecake Factory, which tends to pay more upscale wages. So lots of good reasons to play this. And again, 78% 6-month return is anticipated. If it holds 35, that's all it has to do. It only has to hold 35. I'm not swinging for the fences here. And you shouldn't either. And this is the thing, you can make this kind of money without going crazy. 34.11 at the moment. See that? That's why I'm not worried about the bet. If it stays in this part of the range, we're going to make 78%. If it's below, we're going to adjust. But losing is unlikely. Unlikely, even though, and again, what happened here? It dipped. And what happened here, in fact, it dipped. But did it last for a year? No. Because there's a real value to this place. When you have a business that's making 10 times earnings, it means it's returning 10% a year. It's returning 10% back on your capital. The bank doesn't give you 10%. And frankly, very few ways, most of these index funds and so on and so forth, they don't pay that. These Raymond James, like I said, I talked about this before. I'm in Florida and people are completely in crisis because all these stupid retirement funds and annuity funds that they set up, they don't pay anything like that. They're not keeping up with inflation. They're not even bringing people 5%, a lot of these things. And since 5% is not enough to keep up with inflation, these guys are drawing down and drawing down and drawing down, and it's killing them. And of course, also, nobody thought you're going to live this long. When all these annuity funds were set up, people's life expectancy wasn't 80, 85 years old, 90 years old. Everyone's pretty sure they'd be dead by 80. 40 years ago, 50 years ago, when they started building these funds and doing the retirement calculations, they didn't think they were going to need this money forever. You know how you used to sit down with a financial consultant and the guy'd be like, well, okay, if you do this and that, then you'll be able to retire and you'll have $50,000 a year when you retire. And 40 years ago, you're like, 50,000 a year. That sounded great, right? So you save the amount you thought you needed to retire for 50,000 a year. And again, and by the way, and that 50,000 a year would include diminishing. So let's say 65, and the guy says, oh, let's say you live to 85. Okay, so if you're going to take 50,000 a year out, you're going to be collecting interest on your bulk. So let's say you have $1 million, right? And you're going to live on 50,000 a year, and the interest on the $1 million should be $50,000, and you should be fine. Or maybe you only say $500,000, and it was going to be $25,000 augmented by the returns on the 500,000 you have, right? Which would hopefully be 25,000 a year, but then each year that you start withdrawing, it would diminish. You know how that stuff works. So if that was your plan, you could be in big trouble. If your plan was to have $1 million left when you die and you would give it to your children, that's what most people are in, actually. Most people thought they would have enough money to leave it to their children. What they're doing now is eating up all the money they thought they were going to leave to their children, and it's the children who are going to suffer, frankly. Because, I got, when my parents, well, my mother's still alive, but my father and my stepfather both died, and my stepmother died. They were none of those generated any real money. My grandfather, when he died, left me some money, and my one of my uncles, when he died, left me some money. So I benefited from inheriting money. Not set for life money or anything like that, but it's, it's nice to get a little bit of boost when you're young and get some cash. That's not happening, and plus the price of home ownership and so on and so forth, it's a big problem. So anyhow, the $700 a month portfolio is an endless supply of great stock picks that we've made over the past 2 years, and a lot of them you can go back and take a look and say, and frankly, most of them we'd make them again. If I don't go over all the old picks, I'm always looking at new stuff. But I bet if you go back over the years, like AT&T was our first pick. If you go back and look at the 100-something stocks we must have gone through in the last 2 years, probably not 100. I'd say 30 or 40. But if 30 or 40 stocks that we cycled through, if some are back low in a channel, then we should cycle through them again. We mostly get out when something matures, but that doesn't mean they don't come back down. But you see how easy that is to set up? It's like a simple portfolio of finding value stocks that, again, that have a catalyst, that you think that there's going to be a catalyst to make it move forward, and then just let it run. And by the way, the delta protects you. So in other words, wow, what the hell is that? The Dow is like totally taken off. I was thinking the last half hour, I don't know what the hell happened. Did anyone see anything? That's crazy. Oh, Bernie says SunPower has terrible management, and these are not the same guys who built it. Maybe I'm wrong about that. I got to check that out. Because yes, I've been watching SunPower for many years. It didn't occur to me that it's not even the same people running it, because they had that split off when they split out Maxtor. That was when the company started turning the jump the shark, or whatever you call it, right? That's the Maxtor spinoff was terrible for them. So let's see, dollars up a little bit. Oil has flown up. Wow. From 5 a.m. until now, it's up more than $2. That's not good. But what the frick on the Dow? What is going on over there? Even the Russell's starting to come back a little bit. Oh, I'm sorry. Oh, I was going to show you something. The Delta's right. So who are we talking about? Cheesecake. All right, yeah, let's talk about Cheesecake Factory. So if you look at cake, October. See, we would have gone further out, but they don't go further out with options. So we took the October 30-35 spread. So it's $4 and $2.60. So that's what? That's 140. Yeah, 140 on a $5 spread. That's fantastic. Here's what matters: the delta. See, the delta is 50 on the short 35s, and it's 74 on the 30s. Okay, so that means that the net of the, well, I don't calculate for that. The net of the deltas is 50 and 75, so it's 25. And that means that for every $1 move in Cheesecake Factory, you're going to lose 25 cents on your option spread. Now the option spread is only $1.40. Okay, but with 10 contracts, that's $250. So if Cheesecake Factory falls $2, we would lose $500. That's really what our risk is. But if it falls more than $2, we would either pull the plug or change or do something about the position. But we're risking, basically, we're not risking $1,400. We're risking about $500 because the delta is protecting you. It's not that you have the stock and you're losing exactly what it loses. You're only going to lose the difference between the two deltas, and because the short calls will go down and your long calls will go down. Your long calls will lose 25 cents more than the short calls in the motion. They'll also make 25 cents more on the way up, but that doesn't matter because you're capped. So really, it's irrelevant. But your potential gain is 78%. Your potential loss, and I'm sorry, 78% being basically $1,500, and your potential loss is $500. So your risk to reward is 3 to 1, or reward to risk is 3 to 1. That's the way you want to structure your plays. So what do? We find a good stock that's beaten down for reasons that we think are not necessary. We've seen the earnings report, it was fine. We have analyzed the conditions of the company. We feel that they're undervalued at 10 times earnings. They're pretty much undervalued. And we think that the time frame is sufficient to realize the value. And by the way, the value is only the current value. We expect them not to go lower. We're not even betting them to go higher. We're just saying, well, we think it'll hold 35. So if it holds 35, we make 78% in 6 months. Very simple spread, no margin required. Not only no margin, but it's self-hedging. The short calls are protecting you. And by the way, that fact is also very important because when we have our total portfolio and we're looking at it, when I have a $18,000 hedge, I don't need $18,000 worth of protection because the positions are hedging themselves. So it's much more than we need as far as protection because we don't have aggressive positions in this portfolio. We don't need a lot of protection because for every long position we have, pretty much every long position we have a short position covering it already. That severely lessens the amount that we're going to get hit on a downturn. Wow. Look at that thing go. And what else? Oh my God, look at all these words. Okay, I don't know if you guys can even see this when I look at the question. So first of all, Bernie also said, do you think they will turn the corner at the end of the year and get to 115? I think Disney is fairly pressed. We talked about this yesterday in chat. They were expensive. We look at Disney. Okay, now they're trading at 20 times earnings. They don't grow enough to justify 20 times earnings. Look at this. 82, 88, 80, no, that's trailing. 82, 88, 91, 96. That's like 5% growth. That's not exciting. Okay, profit growth. 3 billion, not 3 billion, much less than 3 billion. Then suddenly 10, suddenly 10 billion. So they real crap here, but they're getting back to where they used to be here. Now, in theory, you figure they can improve their margins back to where they used to be, and it should be good for them, but that's not necessarily true because now they have a lot of this growth in revenue is coming from some very expensive stuff like the Disney Channel, which is why they had such shitty numbers here, is they were building and growing to have their streaming services, and also by the way, they're spending a ton of money on new parks, and not new parks, but expanding the parks that they have. And we all saw what a disaster the Star Wars hotel was, right? That was a complete waste of $1 billion for this company. And I would be pretty pissed off if I was a shareholder on that thing, because man, did they blow it. I mean, that was a complete disaster. There's a new Star Wars section of the park. There's still some value to the section, but the hotel itself, total disaster. It just did not work at all. They have a pretty large amount of debt, $40 billion in debt, or 32 billion debt. I'm not, yeah, probably more like 32. It looks like they paid down some debt. That working capital is kind of ugly too. It's not a lot of working capital. That's disturbing. especially because they are building and building and building on their parks. Their movies, they've had a bunch of duds. We went over their lineup going forward, and it's pretty good. They've got a few guaranteed, like they have Wolverine versus Deadpool. They've got a remake of Cinderella or something like that. Might be a bit late for a remake of Cinderella, though. I wonder about that. Cinderella, the one? No, Snow White. No, the dwarfs. So they, it's like a remake of that. They've got another Moana. Yeah, Moana. They got another Moana coming up. They got another Inside Out coming up. So they got a lot of almost certain to make good amounts of money movies coming out after going through this trough, which was partially caused by the writer's strike. But anyway, even if they get back to $10 billion in earnings, even if they get back to $10 billion in earnings and everything they're doing now works out, there's still a $200 billion company. That's still 20 times earnings. These guys should not be trading at that kind of multiple. Oh no, that's just EPS. Okay. With PE. Yeah, their normal PEs are down here, 14, 15, blah, blah, blah. They had a little spike up during COVID, but that spike up, by the way, isn't because Disney was doing great. It's because earnings crashed, and the stock didn't crash as fast as earnings. That's why the PEs jumped, okay? The reality, though, is this is where they should be trading, below 20x. There's no reason to give them a prime multiple. They're not doing anything that's going to massively grow. The streaming services are in a dog and cat fight, right? They've had ABC forever. That's not going to do anything exciting all of a sudden. ESPN is not going to do anything exciting all of a sudden. I don't know who's got the Olympics this year, but that's not going to be. It's already factored in. I mean, the Olympics aren't going to surprise anybody. The commercials are sold. Everybody knows what they're making. It's a very cash intensive business. The studio business is cash intensive. While don't forget we had a writer's strike, right? So it screwed things up. But now that they're getting back to normal, it means we're back to paying writers to write things that will be shown in 2 years, and they need a string of blockbusters to keep things going. So I don't see any sudden improvement. I don't see any bargain here. And that's for me. If I don't see a bargain, what am I in it for? It's Disney. Yeah, it's a good company. Like IBM right now. It's like IBM's fairly priced. I'm no longer interested in IBM. I love IBM. I love Apple. Apple is fairly priced. It's not underpriced. I have much less interest in it if it's not a value. It was a value when it was 80. We bought some when it was 80, but at 100 plus, it's not a bargain. Come back to 80, absolutely. I'll pound the table on. I'll say, why the hell did it sell off to 80? What the hell's wrong with people? Blah, blah, blah. 80 is only going to be 16 times earnings, but 16 times earnings is where I want to own Disney, because it's freaking Disney. Disney is our culture. We don't really have much culture in America. Disney is our culture. It's probably not going to go away. It's very hard to replace something, it's you give it to your kids. You basically you inoculate them with Disney when they're born. You got Disney characters in the playroom. They got Disney sheets. They got Disney underwear. They dress up as Disney for Halloween. You read them Disney stories. They watch the Disney Channel. They play the Disney games. How the hell are you going to unseat this company? This is how Americans raise children, and in other parts of the world too. I mean, this is how we raise our children. So how could you bet against that? And that's why they bought Marvel, because they were losing the kids. The kids get to be 10 years old. They start losing interest in Disney. Disney gets in bed with Marvel, right? And they capture, the next 10 years of the kids. They catch them until they go to college. And then they got the Pixar crap, right? Then they got Pixar, and they have a Star Wars, and then they get Star Wars. So now you got the kids in college, and you get them 30. Disney is basically block by block by block creating a space that keeps you engaged your entire life. Because you know what? You want to have the 30 and 40-year-olds because the 30 and 40-year-olds are raising the next generation of kids. So you want to make sure they love Indiana Jones, they love Star Wars, they like Pixar, they have fond memories, they give the kids the toys, the kids, you know, the aunts and uncles give all the toys to everybody, and everybody's getting Disney everywhere, and it's all one big culture. That's exactly what this is. It's completely embedded in our culture. So long term, you always bet on Disney. It just you can't. I mean, look at Warner Brothers. Warner Brothers really screwed up. I mean, they Bugs Bunny and crap like that, and they let that stuff die. Not Disney. They refresh. They push the brand. They understand how to keep it going and move it and make sure that everybody knows who they are all the time. And they try stuff, and they try stuff and it fails. So what? Okay, they try again. But whatever, they push, they try, they have influencers, they do the Hannah Montana thing, which is Miley Cyrus, right? So Miley Cyrus, when she was a child, was Hannah Montana on the Disney Channel. So was Gomez. Selena Gomez was a Disney kid. They find these young kids who are going to be the next generation of stars, and that's another way they keep people in. By the way, the Disney concert movie of Hannah Montana and the Hannah Montana Miley Cyrus concert, I saw that with my kids, and believe me, I did not want to be there. It was one of the best concert movies I ever saw. It was shot so amazingly well. They did a phenomenal job. The entire movie was amazing. I highly recommend it. It was just from a cinematic standpoint, it was incredible. And of course it's Disney. They have a stadium full of kids, but they had 20 like cameras in the middle of the stadium blocking people's views. You know, really obnoxious stuff. But you know, I guess they put up with it. But that's what Disney can do. They can sit there and redo whatever arena it was, but some big giant indoor arena, and put camera stands everywhere and have 20 different angles of every single thing that's going on stage. And of course, they was filmed in IMAX and with incredible sound and so on and so. It's crazy, but it's great. It's great that there are companies that can do this. It's great, you know, Disney and Apple are companies like that they can blow out all the stops and just make the spectacular event that endears them to their fans. And boy, were they endeared to my kids. and Miley Cyrus is still going. Let's see. Okay, we talked about that. Now Rick is asking, holy cow, what is Rick, what is this? Components of the Dow Jones. Oh, Rick is talking about why the Dow Jones is up. Okay, well, very difficult to read, but we can find out. That I know is something else we can easily look up. Oh, no, don't look at the debt. Don't get me started. What the hell was I just going to look up? Oh, Dow Jones components. And CNBC is the best one for me, that one. There we go. Who's moving the Dow? Oh, come on. Oh, screw off. Open in incognito window. There you go. No more bothering me. So with the Dow, unlike the other indexes, it doesn't matter. There's no, you don't have to worry about the market cap. It's who's doing what. Oh, Boeing. Good for Boeing. $4. See that? I don't know. There's no particular company banging the Dow up. They're just having a good day. So you got Amgen's having a nice pop, and you got Amgen and Boeing, but there's no spectacular. You know, it's not like that time that was it Salesforce or somebody had like a $20-something gain, and that's just huge for the Dow. So here we go. Oh, the S&P is red at the moment. The Nasdaq is red. Did everything turn back down? While I was talking, did everything fall apart? No. Why is it so weird? The Russell is down. What is going on here? No, that checks. But the Dow's up 150 points? How totally weird. Yep. All right. Whatever. So I guess one of the reasons though is that the Dow doesn't have any small caps, right? Small caps are dragging everything down. The earnings of the small caps, as we saw from looking at it, they are not very exciting and they are dragging things down. The Dow doesn't have any small caps, do they? It's only 30 huge companies. And they've all reported already for the I'm pretty sure they pretty much all reported. Look at that. Damn it. I mean, that's a big move, and look how far above they're two uh-oh. Oh no. Oh, that's gonna bother the shit out of me. They're two somethings. I used to know this word. Standard deviations. Ha ha ha. All right. God, that's horrifying. So they are two standard deviations above the middle, whereas the other ones are all at, he's one deviation below. They're at the middle, right? And the Dow is two above. That's a weird spread for the market. But it does, the overall indication is that small caps are dragging down the NASDAQ and they are dragging down the S&P. Not small caps, but mid caps, let's say. And having zero effect on the Dow, which is just popping. And it's a broad Dow buy-in. So I guess people are moving money back to large cap stocks. And that makes sense because if you look at the very scary earnings reports we looked at, that you can see why, especially starting Monday morning, I would have been freaking running out of small cap stocks Monday morning because that was a really horrendous looking set of reports. All right, so that's where that is. And you can go now. Thank you. Thank you for your free help. All right. We talked about all these guys. That's done. This is a great picture, man. So this is a self-portrait by Quixote, who's our AI, AGI. It signed it. I love that. That's how he sees himself. You know what's weird though? Nobody ever asked a question on the weekend wrap up. I don't understand that, guys. It's like nobody ever asks a question on the wrap up. That's why I stopped doing them, frankly. I only did this because the capacity increased, so it's actually quite easy for me to do a wrap up. Not as good of a wrap up, frankly, but I just fed him the entire week's worth of posts and comments in one shot. I just scrolled the entire week's worth of posts and comments, and I just dumped it in and said, "Here, do a wrap up." And he's like, "Sure," boom, and that's what came out. It's freaking great. So I'm like, why not? But it's just it's not as good as the ones we used to do because I used to do it day by day, and then I would put them together. But that was work, and nobody reads the freaking thing, so I got tired of doing it. So I was like, why? I'm like, what am I doing this for if nobody's actually commenting or doing anything? But anyway, did nice. It's a good job. It's a nice, concise weekly wrap up, giving the highlights of each day and so on and so forth. And I could have told him to be more wordy, but I read it and I was like, oh, it's pretty damn good. Why change it? Anywho, so I'd appreciate some more enthusiasm on the weekly wrap up. So that's what I'm saying. If I'm going to do them, I'd like it if people participate, bring up. I mean, don't you guys read anything? Do I have to read everything? Like tell me what's going on. Bring up some news articles. Let's talk about stuff. We talked about Apple. This was also a fantastic image produced by the AI. I really like that, actually. It's nice. And the AIs are getting much better at putting words into things. So that's I'm gonna see if we can work on charts, because if we can put charts with labels and things like that, like this, that'd be really cool. I never tried charts at all. I know they can make charts. I never tried charts because there's no point if you can't put words on it. But now they can start, now they're getting much better at words, which is horrifying. If you're an artist, especially, it's like, where's my job going to be? So now they do graphic design. Now they can totally like correctly put words into things. And, oh, I wonder if you can see my, oh, no. I don't have it. Yeah, I did a really cool one of my mother's dog for her yesterday. It was cool, fun. So what I talk about today, so the NASDAQ, right? Oh, you can't blow that up? I'm sorry. I thought if you clicked on that, it would get bigger. That's useless. Wow, nobody tells me these things. That is pointless. I thought if you clicked on it, it would enlarge. So I was like, why take up all that space when they can just click on it? But it didn't work. Anyway, so I know what chart that is. Hang on a second. That's this chart. It's crazy how efficient I am, right? Like I know I've done this for so long. I know where everything is and what goes on. Anyway, so here's the NASDAQ. This is a this is ours. Okay, there's another one of the hourly charts. Oh, we did look at this earlier. I'm sorry, we looked at it. We looked at it because I said it popped out. It did pop over. So here we are at the 18,000 line basically, and we want to hold that. And if that holds up as support, great. If it doesn't, we're going to have some problems. We could come back down into this range. I thought we'd go back to 16,000. I thought we'd be down here, and I didn't mean now, but I mean at some point into the next month or two, we should be back down here, and that's what's going to be necessary to bring the RSI back down to this range. But it doesn't have to happen quickly. Look at this RSI. So, you know, here's when the RSI was really oversold. Here's how long it took to work itself down, and that didn't stop it falling either. So, you know, it's not what you think. The only thing that's definite is this is too much and this is too little. That's the only thing that's definite on the RSI. Anything in between is hard to gauge. But when you see this, it's going to go down. When you see this, it's going to go up. We saw this, and it's not going down yet because we're still working through this range. But it does need to get some time below 50, more time than it's spent over here. So, and also this cross down, and these things don't work themselves out very easily without causing a sell-off, as you can see over here, right? See, no particular sell-off, right? Had to move up, no particular sell-off, even though it was crossing, move up, even though it was crossing, move up, even though it was crossing. Takes a while. As it goes down, it creates a drag, and then you can get into big trouble. All right, so from the technical standpoint, that's what you got to watch out for. Anyway, that was the chart I had there. But the main point I wanted to make in the morning post was to say, you know what? There's really like 3 stocks that have driven 100% of these gains. This is since the beginning of last year, beginning of 2023. All of these gains were from the Magnificent Seven, all 53%, 0% of the S&P, 0% for the other 493 companies. These 7 stocks are up 53%. Earnings, look at the earnings. In 2022, the Magnificent Seven was losing money. The rest of the S&P was okay. Then suddenly in 2023, huge gains for the Magnificent Seven. In 2024, expected earnings are also huge for the Magnificent Seven. But last year, the rest of the S&P lost 4%. And that's why when you look in these earnings and you say, oh, why did the stock go down? And earnings weren't so bad. They weren't that good either. Nobody has good earnings. The entire S&P 493 next stocks are losing money. They're not making money, they're losing money right here, minus 3%. So, and that's from last quarter, that's not even from last year. So they're hoping to get back to 8% for the year by doing this. This is what's expected to get us to 8%. If we don't grow, if we don't go from -3 to +6, then all this gets recalculated and it's a problem. But also, what's the big deal here? It's not even the Magnificent Seven. It's Nvidia, which is way overpriced. It's Microsoft, probably fairly priced. It's Meta, Facebook. They're overpriced also a bit. They're a little bit, probably trading about 30 times earnings. And then you got Apple trading close to 30 times earnings, a little too much. And the other guys don't. They really, Google, and Google, by the way, has a huge problem. Google search is going to be in big trouble because Google search, even if they mimic what the AIs are doing, that's what they are doing. Even if they put AI into their current search, it's still not better anymore. Perplexity, you can try that one. Perplexity is actually a better search engine than Google. It's online. You can search things on that. And Copilot, which we've been using. That's my Shellbot, basically, is a Copilot based system. And that has direct internet access. It's getting better and better. That's the thing, by the way, notably better. Shellbot used to be completely unreliable. That's why he's got a stupid face when I put a face up for him. He's got like a dopey face. That's because he used to be dopey. He's not as dopey as he used to be. He's pretty good now, getting correct information. And I said, and then I got off on a tangent because I was starting to talk about this, but then I started saying Apple alone has enough cash to buy the bottom 470 companies in the S&P 500. Any one of them. And then I went from that thought to this thought, which is, if you think about Apple makes 10% of all the money made by corporations. That's kind of scary, right? And Microsoft makes Microsoft and isn't far behind Apple. And then there's Google, and then there's whatever. That's it. So it literally is the Magnificent Seven making this money, and hardly any money is made by anybody else. Who makes the rest of the money? The financials and the energy. So you have a few companies here making almost all of this money, and the scraps go to these guys and these guys. I mean, obviously, they don't make this money, so that's it. Apple makes $100 billion, $100+ billion of that money is just Apple. Microsoft is most of the rest, and then there's hardly anything left. That's insane. Healthcare is great, right? That's oh my God. They're just taking money right out of your pocket. That's what financials do too. Don't forget, financials are just taking fees from you. That's how they make all their money, is by charging you fees. And think about that. They're not necessary. AI makes them completely unnecessary. All the data and the protection and everything else that the financials make all this money from, it's mostly not necessary anymore. In fact, frankly, if we adopted cryptocurrencies, you wouldn't need them at all. We could run the entire banking system with a couple of AIs and cryptocurrencies. And again, they'd have to be secured and so on and so forth. It would lead to a massive, probably $1 trillion theft in the banking system or whatever, but we could do it. Well, as far as running it, it could be done. This money, that $138 billion is money that is just basically, those are your fees that are taken out of your wealth on a constant basis. That's what the financial sector is. It's a drain on you. Healthcare sector is another drain on you, because the healthcare sector isn't doctors. That's not what healthcare is. Healthcare is all the middlemen who make the money. It's the hospitals who run the building that the doctors work in. It's not the doctors themselves. The doctors themselves don't need to charge you $3,000 a day to stay in an operating room, or not an operating, a recovery room. That's not the doctor's money. That's the hospital charging you insane amounts of money, completely ridiculous amounts of money to be in a space after you are operating on. They can't give you a private room for that money, for $3,000 a night. Then while you're there, if you have an aspirin, the aspirin's $50 and so on and so forth, right? It's a racket. It's a middleman racket, and the thing about AI is it's going to cut out so many of these middlemen rackets. Oh, and by the way, notice we're the only country where healthcare is a significant source of revenue. Oh, I'm sorry, no, in Europe. Here in Europe, it's $60 billion. They have more people. They have 500 million people. We have 330 million people. They got more people than us and spend half as much on healthcare. They have 60% more people spending half as much money. No, it's less than half, right? This way, it's practically a third. We're morons. we are just suckers, huh? But the rest of the world, no, they don't spend money on healthcare. Healthcare shouldn't cost that kind of money. It's insane. My friend Ken's in Thailand, and he had sciatica. He had sciatica. So he went to the hospital. He was in a lot of pain. He went to the hospital. They do tests, MRI. He sees 5 or 6 different doctors. They're talking to him and whatever. As different specialists come up, all walked into the hospital, and they run a battery of tests. They consult with doctors. They got people on him. They had him in there all day long, and they gave him prescriptions and so on and so forth. Okay, so he's coming out, and he goes to the front desk, and he asks, they're settling the bill, $350. That's a private hospital with all the same equipment. He said actually it was like one of the best hospitals he's ever been in. But they got all the same equipment, all the same stuff. The doctors went to the same goddamn schools. They probably half of them went to Harvard and things like that. They did all the same things, all the same tests, all the same equipment from the same freaking companies, taking the same pills, everything else. $350 versus at least a few thousand in the US hospital for the same thing, at least. I hate to imagine what it would cost. They charge women $10,000 to have a baby. I mean, that's a pretty simple procedure by comparison. So that's a problem. Anyway, so that got me started, and then it went out of control, because then I started talking about the corporate wealth and the distribution. And you have to realize what's happening in this country, though. We were here in the 1990s. We were here. And look, when we had the big boom in the 1990s, when Clinton was president and everybody was happy, and everything was going great, and we had the dot-com boom, right? What happened? These guys got richer, right? The 50, not the bottom half. They stayed pretty flat, but well, they did get a little richer. But these guys got richer. The middle class got significantly wealthier. Even the upper class got significantly wealthier. That's a much fatter piece of the pie, right? The top 10% they got wealthier, but not like they didn't really eat into anything, right? Then that all started changing. And come around here, really it started here in 2008. Basically, there's a big boost in wealth for the top 1%. Then it went back down a bit. They didn't like that. And then we get into the they had then we get into the Trump era here, right? starting here, and as you see, big fat thing, making nice gains, right? And then everybody makes money, but this explodes. When COVID hit in 2020, right? This exploded. All that bailout money, all those special things and everything to boost the economy went basically into their pockets. All that trillions of dollars of stimulus that we all have to pay the bill for, that's our national debt. We all have to pay it back, but these guys got the money. So, and the top 10% got a lot of money too. But this wealth gap has gotten completely out of control. This is the bottom 90%, $50 trillion of wealth for the bottom 90%, okay? This is 100, this is almost 150. So 2/3 of the wealth is now in the hands of 10% of the people. And it's you know, is what I got to this because I was saying, you know, like, look how ridiculous this is. You've got a few companies that make all the money. And then you have a few people who own those companies, like Warren Buffett owns a huge portion of Apple, right? You got a few people who own those companies. And so the concentration of wealth is doubled because the top 1% own the companies that make all the money, and they're going to keep making all the money. And they're going to get richer and richer, and the companies are going to grow and grow. And eventually, it's you know, you're going to have we're not stopping monopolies or doing anything to rein this stuff in. We're not taxing the wealthy and taking the money back, which we used to do. We don't tax wealthy people. We don't tax wealthy corporations. Not at the kind of rates that they used to get taxed at, which were 60%, 70%. Because when you have $100 billion, see, that's the thing. How did you let Bill Gates, Warren Buffett, Zuckerberg, Bezos, how did you let these people have $100 billion? Seriously, nobody needed that money more than them? Is enough never, ever enough? Can you never say stop? We used to have a concept that, like, you could be too rich. And we used to tax people at that kind of level. You know, I'm not saying somebody doesn't have the right to be a billionaire, but it shouldn't be easy. You shouldn't be able to snap your fingers and be a billionaire because you had a unicorn company and had a lot of stock, and all of a sudden you're like a billionaire, because that money came from other people. It came out of the economy and went to one guy who can't possibly spend it. I think Bill Gates and Mark Zuckerberg both just launched $300 million yachts. Bill Gates runs on hydrogen, which is cool. Mark Zuckerberg though. So anyway, and Bezos is like, forget it. Bezos is super yacht. His went out already. Anyway, these guys are so rich that it's not even a consideration in their balance sheet to have a $500 million yacht. But if you're a yacht owner, these guys used an entire shipyard for a couple of years building their yacht. That means that your yacht was more expensive because they were using up all the resources. There's a finite allocation of resources, and that's why when one guy buys 12 houses, we all suffer. There's more than this, you know, it's not, you know, you tax wealth to prevent it from accumulating into the hands of very few people so that you end up having a monarchy. Because, in fact, I'll show you why. Where's that stupid calculator? Here you go. I'll explain this very simply. Compound rate calculator. Okay. This is going to break the calculator, I'm sure. We're going to find out what the maximum amount is. So $100 billion. Okay, and no annual addition. So Bill Gates has 100. Bill Gates still has $100 billion. He's given away $200 billion. He still has $100 billion. If he hadn't given his money away, he'd be the richest man on earth by a mile. And especially because he could have instead accumulated that money and turned, he's been rich since the 90s or the 80s. He's been rich since the 80s. I mean, he could have turned that into whatever. Steve Ballmer stood in his shadow and got $20 billion. So Bill Gates has $100 billion. You don't add anything, but you just give it. Let's say 20 years from now. Let's say he lives 20 more years, and let's say he makes 10%. Okay, $672 billion. Now keep in mind that Bezos and Musk and Zuckerberg, and they've got this much money now. 20 years from now, at 10%, they'll be basically trillionaires. Okay? Then they're going to leave that money. So imagine that there's no inheritance tax, right? So now they're going to leave $1 trillion to their kids who have it for 40 years at 10%. $45 trillion. I'm sorry, that's each. That's each family. $45 trillion each. Now, let's go back here. That is all the money. Okay? 40 years from now, those dozen families or whatever that are 100 billion now will be, if they don't give the money away willingly, and if nobody taxes it, they will have all the money. They're the top 1%. They'll be in this group, and this group. Oh, I'm sorry. This is the top 0.1. They're in this group. This group will double and be off the top of the screen, and it won't matter what you have. And this is how it is now. It's like if you go to it's like if you bid on a house. If you want a house and you've got the money for it, you only have to worry about the rich people who are bidding against you. You don't have to worry about the bottom 90% bidding against you. You only have to worry about two guys who are bidding on a house besides you, because it's already crazy prices and nobody can afford it, right? You go to an auction and you're sitting there looking at a painting, and you go, oh, I'd like to buy that painting for $100 million. How many people are going to bid against you for a $100 million painting? It's got to be in your taste, right? So it's got to be in your taste, and you have to have the money, and you have to have the space on the wall, and you have to have a wife who isn't going to kill you. There's a lot of factors there to buying these paintings. But that's what the problem is, that this is too much money for somebody to have. It's all the money in the world. And just math takes that money and draws it to them. For them to get 10% on that kind of money, 10% being on $1 trillion, on $100 billion, for them to get $10 billion a year, and it accumulates and accumulates until when our kids are our age, these people are going to require $100 billion to feed their wealth at 10%. They can't possibly spend the money. But if they want your house, they will have your house. If they want your car, if they want your company, if they want to buy your sports team, none of it will make a tiny dent in the amount of money they have. And that's inflationary for you. It's more for them, less for us, because we allowed this ridiculous unequal distribution of wealth, and it's going to destroy society. That's the point I was making today. You're doing it. You're not even, we're just not even doing anything about it. We've completely abdicated our responsibility to shape society's future, and we're just handing it over to, and again, these are essentially random guys, because there's more of them being created all the time. Who's going to have the next unicorn? Who's going to be the next billionaire? Who's going to make the next 100 billion? Could it be Sam Altman? Probably is going to be one of them. Where did he come from? And how is Sam Altman different from Sam Blankfein? Yeah, right. Sam Langfine, if he hadn't been such a moron, he could have been one of those people too, and his insane children would have been running the world. You're giving these people all the money in the world. Just from that aspect alone, it's ridiculous. But you think there's no repercussions. You think you're playing this game. You're not in that game. Nobody's in this game. Wait. These are the people who are going to have all the money. Just these people. These people are going to get. These people will be in as bad a shape as these people. You can't mathematically. You can't do this. They are going to suck up. It's like black holes. Their wealth is going to require more and more and more of the surrounding wealth to sustain it. To give them a fair rate of return on their money, it's going to require all the rest of the money. And there will be nothing left, because as they accumulate, what is their wealth going to be in? It's going to be in businesses. They're going to own all the businesses. It's going to be in cars. It's going to be in cars. It's going to be in real estate. They're going to own all the beachfront property, not some of the beachfront property. Why should they own some? From an investing standpoint, they've got trillions of dollars sitting around. What are they going to do with it? Well, I guess you better buy Florida. Or you may as well just buy Florida. Take over the whole state, privatize it. How do you think people became kings in the first place? Generational wealth over time, accumulating unchecked. Eventually, those people own the entire country. That's what we're doing here. We're handing our democracy. We had a whole revolution 200 years ago, and here we are handing the country back to an oligarchy. It's insane. Okay. Anyway, all right. That's my time. Thank you for listening. I didn't want to get too much of a rant, but you know how it goes. And Rick and Bernie said they're going to comment on the weekly wrap-ups. That'll be much appreciated by me and my robots. All right, guys. Thank you very much. And we will do this again next week. All right. Take care, everybody.